Hello, my name is Shubomi Plumter, and in this video, I'm going to give you an insight into the mind of an investor. So this is for entrepreneurs raising angel funding, venture capital, or debt. But what I'm going to do is flip the view and show you what investors look out for when you approach them for funding. So this will help you. It would reduce the amount of time you use to try to convince investors to put money in your business, because it already gives you a sense of what an investor is looking for. I can help you prepare your business or your idea ahead of time before you approach a potential investor. So let's go. I'm going to cover the prepping stage. What are the things you need to know or the things you need to do before you start approaching investors? Investors could be family, could be friends, could be institutional investors like VC firms, banks. It could even be prepping you do before you apply for an accelerator or a competition. I'll talk to you about some of the things that happen before you raise funding, some of the things that investors would ask for or institutions would ask for, and then finally talk through some of the things that you'll be required to do once you get funding from an institution or an individual. So let's start with the prepping phase. The first thing you need to ask yourself is, are you prepared to become a business? And because I've prepared this presentation particularly for creative entrepreneurs or creatives, it's very important to really think about this point, because as a creative, you're used to having total control over your ideas or over your products or over your output. In fact, for a lot of creatives, you are the product. It's your skill, your ingenuity, your creativity, your brilliance that produces a product. So a lot of times you're used to, charting the creative direction. You're in control of the product. You are the product. So for a lot of creative entrepreneurs, you need to ask yourself, are you prepared to separate yourself from the product such that the product becomes a business entity in itself, such that even if you're not around, the business can run without you and can even grow and thrive without you. So yes, you bring that initial ingenuity and creativity, you bring your name, you bring your brand, the strength of your brand, but are you ready to build a structure that can exist without you? Because building a business will slow you down. You're not going to be able to make decisions as quickly as you used to. You're going to need to consult, you're going to need to collaborate. You're not able to spend the proceeds from the business anyhow you want to. So it's something you need to think about, because it's going to determine how far you go once you begin to raise funding from investors. So please, are you prepared to become a business? And becoming a business means you must incorporate an entity. So it could be a limited liability company, whatever business structure allows you to sort of separate yourself as an individual, separate your bank account from the business bank account, from the business name. So you need to incorporate an entity, and before you raise funding, try to do this first. Sometimes even when you raise funding, the investors may ask you to maybe change the structure of the entity, or maybe expand it. Let's assume you registered a sole proprietorship. At the point at which you're raising funding, the investors may say, oh, let's turn this thing to a limited liability company or a special purpose vehicle or whatever. You're going to hear some of these terms, but the most important thing is that you're going to be required to register a corporate entity, and that corporate entity must have an operating agreement. Now, don't be scared about what an operating agreement is. It's just a simple document that talks about how the business will run, and if anything were to happen to you, what's the succession plan. And that's because when institutions or investors put money into your business, they're very interested in the sustainability of that business. Again, because for creative businesses, if anything happens to you, that affects the fortunes of the business. So they want to know that there's some sort of structure in place, even if it's just a simple organogram that shows if anything happens to you, this is the person that takes over the business. A lot of investors get scared if they think, oh, if anything happens to you, your spouse is going to run the business, especially if the spouse doesn't have the management capacity. So investors want to clearly see that you've separated ownership from management. They don't mind a situation where your children or your spouse inherit your shares, but they want to be sure that in inheriting your shares, it doesn't necessarily mean they become the managers of the business. Only a competent person can manage the business, and they want to be sure that you've taken care of that within the operating agreement. There's an organogram, there's a simple succession plan. It doesn't need to be many pages long, but there should be a clear indication that you've thought through how the business will run if anything whatsoever happen to you. The second thing is that you must move your intellectual property into the business. So you'll find that for a lot of creative entrepreneurs, whether it's a Dr. Dre, for example, putting his name on the Beats by Dre headphones, his name has been transferred as an intellectual property into the name of that product. So you'll find that for a lot of creative entrepreneurs, you need to get used to moving your name or moving your creative assets, moving your logo into the business, because that's part of the brand equity of the business. That's part of what the investors are paying for. So again, it's one of the ways where you need to separate yourself from the business. Your legal government name is different from your brand name. And if your brand name happens to be the same as your legal government name, then that name is going to be trademarked and become a business asset. And once you move that intellectual property into the business, it becomes part of the brand asset of the business. So are you ready for that? And that's one of the reasons why I say that as a creative entrepreneur, you need to be sure you're ready to turn yourself into a business. Because once that brand name goes into the business, you can't just use it anyhow. You must take permission from the business before you can use that brand name for other things you might want to do in future. For a producer, for example, a movie producer, the script is your intellectual property. And if you're going to raise funding for a movie, that script goes into the business entity. So it means you can't wake up tomorrow and decide, I'm no longer working with you guys and I'm going to produce my film somewhere else. You no longer have ownership of that script because the script was used as a brand asset to secure the investment for that film. So it no longer belongs to you, it belongs to the investing entity or the business. So those are some of the things you need to begin to think about as a creative entrepreneur. It's also one of the reasons why it's very difficult to raise funding for a music project, or if you're a musician, and that's because a lot of times the only intellectual property you bring is that initial album that is funded. So let's assume I'm an investor, I'm a record label, and I have a 3-year contract with you. Unfortunately, the only IP that I have right now is the album that you've released as at today. What if you die by year 2 and you're not able to produce the next 2 albums? What if we fight and you walk away from the contract and you say you're not, recording any more music? I've literally lost my investment for the next 2 to 3 years because there's really nothing I can hold beyond the initial publishing rights from your current, album or your current singles or the whatever residual streaming income I can make from that. So a lot of times it's very difficult to value a music artist because you're trying to value what has not yet been produced. It's also the reason why, again, for film producers, a lot of investors are very shy around signing multi-movie deals because, again, If anything happens to you, maybe you're the brilliant producer, you're the brilliant director, and you don't have a movie production structure that can exist outside of your individual brilliance, then what happens? What happens, to that investment? It's almost like me trying to fund a Tyler Perry today. With a Tyler Perry, you can see that he's begun to transition from being a personal brand to being a business mogul and a business entity, such that, yes, initially he used to be the one writing the plays, writing the movies. He also used to act in his movies. He used to direct his movies. But now you can see that he has other structures around him, such that, God forbid, if anything happens to him tomorrow and he has some movies in production, you can almost tell that at least that movie will be completed, even if something happens to him, because he's now built a structure around his business, and it's not just him alone, even though he still is the creative genius behind that business. The next thing you need to understand is that all investments and expenses will flow into and from the business. So when an investor is going to put money in a creative entity or into a business, that investment is not going to your personal account. And that's one of the reasons why you need a business entity that can receive that investment. Sometimes the investor would insist that that business is registered in a location or a jurisdiction where they have control. So, for example, part of the reason why a lot of African businesses would incorporate in Delaware in the US is because if there's any dispute, the investor wants to adjudicate in the US and not in Africa, because in Africa it takes years sometimes to resolve a dispute, but in the US it takes months. So the investor may insist that your corporate entity is domiciled outside of Africa, or at least in a jurisdiction, because there are some jurisdictions in Africa where the court system is pretty efficient, the law enforcement system is efficient. So don't be surprised if an investor insists that your business entity is registered in another jurisdiction from the one where you're domiciled or you're resident. It's because they're trying to protect their investment in the event of a future dispute. So please note that all investments will go into the business, all expenses must flow from the business, and that's because the business will be audited from time to time. So please do not collect monies from an investor if you're not comfortable with your bank account statements being seen by the investor, and that is why you ensure that the investment comes into a business entity. So they have no business with your personal bank account, but the business bank account must be open to audit by an external auditor, and typically the external auditor must be approved by the investors, and usually it's the investor that puts the most money that would typically have the biggest sway. So let's assume you raise funding from 4 or 5 investors, usually to be an investor that maybe has put over 50% of that investment, that will be very particular about how those monies are spent. But the bottom line is your bank account must be made available to an external auditor. So that's why all investments and expenses must flow into and from the business. So there's that clarity. And then finally, the business can be sued. Again, this is one of the reasons why investors prefer to deal with a business entity that is registered in a jurisdiction where they have some control or influence. So if there's any dispute, they can almost predict it's going to take X number of weeks or it's going to take X number of months to resolve that dispute. So very rarely, if you look at the fintech evolution in Africa, you'll see that a lot of the fintechs have their headquarters and intellectual property registered in Delaware in the US. And that's because investors are more comfortable dealing with a US entity. The operations can be in Nigeria, the payroll can be in Nigeria, but the intellectual property and the company that is being invested in, typically investors will insist that you register a US entity, and that's because they don't want any issues. If there's any sort of business dispute, if you need to be audited, they want to be sure that things are done, properly within a jurisdiction that respects law and order. Now, let's go to the pre-funding phase. I'm going to assume you've made up your mind to become a business. You've made up your mind to separate yourself from the business entity. You've made up your mind to pull in your intellectual property into a business entity. So I'm assuming you've taken that time to think about it. You know that your brand name will now become part of the business entity. You've thought about how your logo will become part of the business entity. If you're a producer or a director, your script, your publishing rights, if you're a digital content creator, your handles. So your personal handles must be separated. So for a lot of digital creators, I usually advise that once you become big, register social media handles that are not in your legal or primary name, your government name, so that your digital content can sit on a business social media handle. Because at some point, when you're raising money as a digital content creator, you still want to retain your personal, social media handles for your personal posts, things you're going to do in 20 years. But the entity that is raising money, the social media handles now become a business asset, because that's the primary platform through which you're spending the money that has been raised by investors. So even if you're building like a studio, you're building different business assets, you're developing merchandise around your digital content, because the social media handles are a major distribution channel, you can't raise money from investors and still insist on owning those social media handles. So those social media handles now become part of the business asset, and it's something you need to think about during the prepping stage before you get to the funding stage. Now, when you get to the pre-funding stage, so you've made up your mind that yes, you're ready to let go of sole control and you want to raise funding for your business. The first thing you need to do is to explain your idea or business in the right format. Don't use a Word document. Look for a pitch deck template, and I've supplied a link to a pitch deck template. You can get pitch decks from some of the most successful startups in the world on that platform. So please look at the caption of this video, the description of this video. You should see the link there. Use a proper pitch deck format. Pitch decks usually are not more than 10 to 12 pages. What they do is they communicate that you have subject matter expertise. You understand the total addressable market, the TAM. So it's not enough for there to be a gap in the market. Is there a market in the gap? So it's not enough for people to want the product. The people that want the product, can they pay for the product? That's the market, in the gap. So do you have enough potential paying audiences? Your pitch deck will address that. Your pitch deck will also address your competitors, because what the investor is trying to understand is, do you really know your market? Do you know your competitors? Do you know any similar products that are out there? So by the time the investor is the one telling you about your competitors or telling you about a similar product in America or a similar product in the UK, so you need to have done your research and be well exposed and know that your investor is going to ask you a lot of questions. So your pitch deck, no more than 10 to 12 pages. Don't bore a potential investor, please. Just keep it short, but use the right format. Ensure you have your financial projections. For a lot of pre-seed virgin companies, you're going to be using cost-based valuation. What this means is, let's assume you want to produce a movie. The cost-based valuation is the budget. So you're literally saying this is exactly what you're going to use the money for, and this is the budget. And it's very easy for an investor to interrogate that, because all an investor needs to do is to look for someone with a similar skill set in the market, send your financial projections to that consultant and ask, based on what this person is trying to do. Is this budget feasible? Does this look like a well thought out budget? So cost-based valuation is typically used for companies that don't have any valuation, so literally pre-seed companies that have not raised any funding. So it's very difficult for you to have an equity valuation because no one has invested in your business before. So at that point, all you have is a budget, which is cost-based. So whatever metric you decide to use, you can, if you've raised funding before and you have an existing valuation, of course, you can do a financial projection based on that. You can do a financial projection based on your future earnings, multiples of your future earnings. There are different platforms or different ways you can arrive at a valuation for your financial projections, but typically if you have a finance person on your team, let them do this piece of work for you. Or if you can find an existing template that accurately fits your business, you can also use an existing template. But typically the investor is going to ask for your pitch deck and they're going to ask for your financial projections. So please have those two pieces of work ready before you approach investors. If you're an existing business, if you've been running for a few years, the investor may ask for your audited or management accounts. Even if you're not raising the funding for that existing business, the investor just wants to know how well have you used money in the past. So if you have an existing business, even if it's not the same sector that in which you're raising the new monies for, you can still use the management accounts of the existing business just to show that, you're used to running a business, you're used to keeping proper books, you're used to keeping your costs low. That can also be a very strong argument for you that you can take to a potential investor for a new business. So please, if you have management accounts or audited accounts, you can also make that available. The second thing is, please let the right person speak in meetings. I tell a lot of founders, your finance guy must be present at every investor meeting. If you're not a finance person, then what you're doing is that you're coming as the ideas person, you're coming as the visionaire, you're coming as the CEO, but investors want to talk numbers. So at that meeting, in fact, you should speak less and let your finance guy speak more, because investors at that point, they want to talk about your financial projections. They want to really dig into the numbers. So if you're not the finance person, the meeting is not going to be very productive for an investor. So please attend investor meetings with your finance guy. And the finance guy doesn't need to be full-time. You can get a fractional chief financial officer or a fractional accountant, someone who only shows up when it's time to talk numbers, and that person knows their job is, when you're going for an investor meeting, their job is to discuss the numbers behind the business. Be prepared for a background check and corporate disclosure. So please, if you currently have a court case against you, if you know that you've done stuff that is going to show up on social media and cast you in a negative light, if your company has an existing debt, if your company has existing contracts that might impact you being able to transfer your IP to a business structure, disclose all of these things. But be prepared it's better to talk than to allow investors to find these things out later, because the investment community is a very small world. So if you have a terrible reputation, chances are it's going to spread to other investors. So please, as much as possible, disclose anything that you think might have a material impact on the current investor up front. Because most serious investors will do a background check, and that background check extends to not just social media and news, but also extends to checking police reports, doing a fraud check on you, and things like that. So please disclose if there's anything you think the investor should know. The fourth thing is you're going to need to sign a contract. So let's assume you've passed the due diligence phase the background check has been done, you've sent all the documentation, your financial projections, pitch deck, audited accounts, all your corporate disclosures. Thankfully, a lot of these contracts for venture funding or angel funding are standard. So Y Combinator, which is one of the most important venture capital firms, in the world, it's based in the US. They've done a lot of work creating template contracts. So what this does is that it reduces a lot of the back and forth. If you have a lawyer that is pretty familiar with the standard investor contracts out there, whether it's a simple agreement for future equity, convertible debt note if you're raising debt, a simple shareholding or equity agreement, a lot of these templates exist. So please use a lawyer that is already familiar with these templates, because that avoids a lot of back and forth. You don't want your lawyer to start looking silly because they're not used to a lot of these global templates, and then they spend so much time correcting things that really should not be corrected if they had the exposure and they had a level of familiarity with some of these templates. So please use a lawyer that has done an investors agreement before. Perhaps they've helped people raise money or companies raise money in the past. They should be familiar with some of these contracts. Contract features, very simple. A standard contract would highlight the investor's shareholding or profit share. So if it's maybe a debt agreement, an investor is not taking any equity in your company, but they're going to share profit after a project has been done, then that contract will have a profit share. So please don't be afraid of collecting debt if what you're trying to do is a project that has a start date and an end date. There's no point giving an investor equity in your company for a project, a time-based project. Equity is for very long-term patient capital. So if what you're building, you're going to build it for the next 10, 20 years, then you can raise equity. But if what you're doing is a project, for example, a film is a project. It's an 18-month project. It has a start date, it has an end date, and it has an off-taking date when you're either going to distribute through cinema or distribute through a streaming platform. So that is a project. Ideally, you should just raise simple debt. It should be a profit-sharing arrangement where an investor comes in and you guys share profit at the end of that process. So determine what kind of funding you need, and then develop a contract to suit the funding that you need. A simple contract to have pro rata rights. Pro rata rights are very simple. It just means that if I invest in your project or invest in your company now, and 3 months down the line you bring in an additional investor, I need to have the right of first refusal in terms of just keeping the current percentage that I have. So if today I have 5% in your business and you bring in additional investors in future, rather than dilute me, I want the right to be able to pay more money to retain that existing 5%. So it doesn't mean I'm going to have 5% forever, because obviously the bigger your company is, the smaller the percentage will be for the same amount of value that I have. So at that point, my shares in terms of percentage will be diluted, even though my shares in terms of value will remain the same. But some investors say, if I have 5% in your business now, I want to continually have 5%, and I don't mind paying that extra to maintain my existing percentage. So that's really what pro rata rights are in simple terms. So the investor has a right of first refusal. If they decide not to put in more money, then of course their percentage share will be diluted. The contract would have the dispute resolution method. So if there's any problem, are we going to arbitration? Are we going to court? Are we calling a group of elders? Are we going to the board? Your contract can have any dispute resolution method you prefer, but it must be stated in the contract up front. So sometimes you see a contract where there's no provision for court because you're trying to avoid dealing with the court system, particularly in Africa. So it ends at arbitration or the board, or it could be a group of elders, but please just state it. And then also your contract would specify financial and operating stipulations. Are you going to send monthly management accounts? Are you going to do quarterly operational reports? All of those things will be in your contract, and it's best, like I said, it's best to keep your contract simple, especially at the starting stage. As you become more sophisticated and you begin to raise millions of dollars, you can then have contracts that are 100 pages, in length. But if you're not raising a lot of money and you're not trying to confuse anybody, then just use a lot of the standard templates that have been provided by global VC firms. Post-funding, you'll probably be required to do management accounts just to show how you're spending the funds. Again, this is where having a good finance person comes in handy. And like I said, they don't need to be on your payroll full time. They just come in, do the work, and then leave. You'll be asked to do quarterly operational reports. Sometimes it could be monthly. So for example, if your project is 6 months long, then you might be required to do monthly reports. But if your project is maybe 2 years long, quarterly reports might suffice. Again, just so that you can flag any issues. Are you running over budget? Are you under budget? Are there maybe requests for additional funding? It could be anything, but just having that rhythm of doing operational reports is required. Sometimes if you're raising debt, the investor will insist on having access to the bank account for the project. So again, it's just so that they can check the management accounts against the actual bank transactions. So like I said, the day you decide to become a business, there must be full transparency. There's nothing like you can't see my bank account, because it's a project account. It's not your overall business account. So sometimes for a project, the investor would say, do a sub account so that you're separating your normal day-to-day business operations, because that's not their business. Their business is only the project. So sometimes investors will say, just open a sub account for 6 months or 18 months, the timeline for the project. Once the project is done, you can close that sub account. But for debt especially, a lot of investors want to check the management accounts against the actual bank transactions. They would require view access to the project account. Sometimes investors want to talk to your team. In some cases, the investor may even nominate the chief financial officer for that project. They may recruit the accountant for that project because they want to know what is going on, with the project. Again, transparency. And this feature is especially important in Africa because the African investment environment can be a low trust environment. So I'm not going to assume and say it is. It can be. So sometimes there are a lot of checks and balances and controls that might be requested of you that may not be requested in other countries. So don't be offended. Don't feel, why are they poking their nose into my business? Just know that it's for a short period of time. Once that project is done, you can move on with your life. So final thoughts. If you're raising funding or you're planning to raise funding, storytelling is important. And that's because if you've noticed, you'll find that a lot of the people who raise funding or a lot of the people who get accepted for pitch competitions or accelerators, it's usually the usual suspects, the same people over and over again. And it's because those people have learned how to tell their stories. And storytelling includes your social media pages, your website, your pitch deck, your PR, the news stories that are told about you. Curate your stories. Don't allow the external audience to define who you are or to define your story. If you need help, if you need to get a PR consultant or you need to get a brand consultant to help craft your story, it's worth the investment. And that's because a lot of times, even before investors meet you, they're going to Google you. They're going to go on your LinkedIn profile. They're going to try to find out, okay, do you have any information on the web? So sometimes you may be a fantastic creative person. You may be a fantastic entrepreneur. You're doing the real work, but you're not telling your story. So if you don't have time to tell your story, hire a consultant so that you can focus on the work and the consultant can tell your story for you. But storytelling is extremely important. And again, because as a creative, part of what you bring into the business is your brand. So if your brand assets are not strong, you're selling yourself short. You're actually reducing your financial value if your brand assets are not strong. Apply for grants. A lot of people don't know, particularly if you're not in Africa, a lot of people don't know that there are a lot of grants that you can get from your bank. There are a lot of grants you can get from the state, from the local government, from the Chamber of Commerce. So one of the things I advise entrepreneurs to do before you start raising equity funding or raising debt, have you checked for grants? Have you checked for free money that the state might be willing to give you, your bank might be willing to give you? So your Google is your friend. Google for grants in your sector. Grants, especially grants that don't require an arm and a leg. So if you have someone already who is in charge of storytelling, a lot of times that person can also help you in putting together your grant application. But look for free money first before you start looking for equity or debt. Apply for competitions and fellowships, and that's because they would give you a platform to share your story. They'll give you a platform to network. They'll give you a platform to meet with other people in your industry, other investors who are looking to fund your project. So please apply. Again, if you have someone in charge of storytelling, that person can also help in putting together some of your applications for you. So that, because I know a lot of times entrepreneurs are so busy, you're doing the real work, you don't have time for a lot of writing, and that's why you need help. But please apply for as many competitions and fellowships as possible. The more you apply, the more you get better at telling your story, the more you understand maybe mistakes you had made in previous applications that you won't repeat again. So typically I advise do a ratio of 10 to 1, 20 to 1. In other words, if you apply for 10 fellowships or competitions, chances are you'll get into one because you would have learned, from your previous mistakes. So please apply for as many competitions and fellowships as possible. A lot of the investors you're looking for, you can find them, during competitions and fellowships. Also apply for accelerators. So if you're an existing business, you have a minimum viable product, an MVP, and you're looking to scale, an accelerator will be a good idea because there you're going to meet VCs, you're going to meet business analysts, you're going to meet financial guys, you're going to meet brand experts, sales experts, pitch experts, and all of these resources are free in an accelerator. So again, I would advise if you have an existing business, before you start looking for external VC funding, before you start, talking to, venture capital companies, have you tried accelerators? Have you tried competitions? Have you tried fellowships? Have you tried grants? These are all low-hanging fruits before you start, knocking on doors of VC firms. So I'm going to leave you with this. Thank you for listening. I hope this has been useful to you. Please reach out to us at opportunic.com. We have a Capital Meets Creatives practice, and I'm sure the link is going to be provided as part of this video. So check out what we're doing to fund creative enterprises. And if you have a business that is not a creative enterprise and you think it might be something interesting for us to learn about, please also reach us through that Capital Meets Creatives platform. Thank you.